Hello traders, as you're probably aware by now, Warren Buffett has just run the annual Berkshire Hathaway meeting. In this video, we're going to be discussing some of the key points of that meeting, what we think of the current market conditions from a technical analysis standpoint, and a dive into the investment choices that Warren made during the 2008 crisis to see if we can get an idea of how to find opportunity in uncertainty. So we'll cover this topic right after this intro. You absolutely have to love the memes at the moment. Elon thinks Tesla's price is too high. Warren Buffett thinks the SPY is too low over the next 20 years. I'd just like to remind everybody to, of course, like, comment down below if you have any questions, and subscribe and hit that alerts button if you're enjoying our content and want to see more in the future. So let's quickly wrap up the big news of the meeting. The first one, Berkshire Hathaway lost around $49.7 billion in the first quarter. Of course, this is off the back of the current crisis. In terms of what Warren Buffett thinks, the biggest takeaway is that he has chosen to sell his entire stake in US airlines at this time. And this is very unusual for Buffett. Most people are very aware by now that he likes to long hold companies. He's held companies like Coke for decades. He buys businesses rather than buying sentiment over the longer term. His current opinion, of course, is no different to what he usually says, which is nothing can basically stop America, not even this current crisis. And he believes that, of course, America will overcome. And if you were to ask him what he thinks about the US economy in 10 years, I'm sure he'll say it's going to be stronger than it ever has been, with more companies worth more money. And that has been his mantra and his opinion for many, many decades. And has he been wrong? Well, absolutely not. And that's why he is one of the richest people in the world. But what makes Warren Buffett so interesting is actually some of the key things that he does during points of recession and points of crisis. So in this video, we're going to be discussing one of his key indicators, which many people don't use and they're not aware of, and then talk about the fundamentals of why that makes sense, what he did during the GFC, and in terms of technical analysis, the kind of key areas that he will be targeting. So let's get into what Warren Buffett did during the GFC. So some of the key things that Warren Buffett did during the GFC is that he invested in companies that he already believed in. So of course he bought Goldman Sachs in 2008. He bought about $5 billion worth of shares and $5 billion worth of warrants. And that's a way he likes to do it. And he did that pretty much straight away. And he believed in, of course, backing them for a long period of time. He then did things like help finance Mars. He helped do all of these different deals. And he made one of the biggest bets that he did, which was to invest in Bank of America as well. Now, Warren Buffett always says, I buy businesses. So he believes in the fundamental core business structure, and that's why he's prepared to buy it when he believes there's value. So we can't all just focus on the idea of investing into Warren Buffett's ideology. And that's because he usually says buy S&P 500 and hold it. That's absolutely fair. But when it comes to making business deals, Warren Buffett does have further leverage, which helps him get investments. Remember, he gets to talk to the board. He gets all of the information and the fundamentals that even we may not get. And it does make it hard for us as investors. So really the key takeaway from Warren Buffett in terms of his investments purely in his portfolio from 2008 was that he believes in the long-term business structure and he buys quality, quality, quality. When we're talking about one of the other things he did though, that would be that he bet on put options. And he did this over a period of time. He actually did it from 2004 to 2008. And he was selling puts and betting that the market would rise over the next 15 to 20 years. So of course these were made anonymously at the time, but they were eventually disclosed by regulatory filings to be Warren Buffett. And he would have made a lot of money off this by believing in long-term success of the US economy. Again, he was proven correct. This actually is an interesting article. And the reason I put this one up from CNBC, it's written a few years ago, was this was about an anonymous trader that actually sold puts. And the reason I brought this up is because look at the expiry time, December 18, 2020. So this person surely would be very, very, very scared right now. because in terms of expiry, they need the market to stay above 2100 by December 18th, 2020, and then they will net the $175 million in premiums. Do we believe they're going to be successful? Well, time will tell, but I'd definitely be a little bit scared if I was this particular trader. Luckily for Warren, he made the right choice and he's got even further puts, and many of those have already expired or been exercised since. So let's now talk about our opinion on the Dow Jones. Now, we've covered S&P 500 a lot. Dow Jones obviously will go very, very similarly with the S&P, but I think it's more appropriate for Warren Buffett's investment style. The Dow Jones are the largest companies, the largest market capitalization companies. And I love the Dow Jones because not only is it pretty much one of the standards, even though the S&P 500 has taken over it, but it has some great resistance and support levels that are being respected during this recent crash. The first one is that we have this very clear level at around 24,000. We can see that we've got the shooting star candle now that is formed on the weekly, and this is live in terms of the market is closed, but this is the Friday close. Shooting star candle, very important candle. And that is actually statistically quite correct. The thing with shooting stars is what we want to do is we want to actually wait until the market goes slightly further underneath the lows. So generally speaking, if you're just trading shooting stars, you always want to wait for a percentage of this candle. So if this candle was, let's say, in this case, it looks like it was about 1,000 points, then we would add a percentage onto that 1,000 points, let's call it 10%, and then we would place a stop order underneath with the extra percentage, just to make sure that the market is truly selling through. Key support here, though, is going to be the 2300 zone. So the 2300 was previous support, and then it could be support again. If it gets through this zone, we expect it to kind of pull up, come test this zone, and then of course maybe even go back down to the 19,000s. But the 19,000 is so important because of the previous resistances we saw back in 2016 and 2015. So from Warren Buffett's perspective, he looks at the longer term, and so should you be if you're more looking at the investment side, or even potentially the 3 to 6 month side of index buying or selling. It's important to know that during times of volatility, absolute key levels are important, but lesser support and resistances will not give you as good an idea of where the market is going. If we zoom this chart out a little bit further, then we can have a look at the 2000 highs and of course the GFC crash. And what may happen in this situation is that if the market was to dive, and let's say right now where Warren Buffett is not finding value in the market, remember he's still not buying in that report, right now if the market came down, tested these lows and then broke lower, where are our next key levels of support? Well, one of them is definitely the 16,000, key level of support. There's going to be a lot of buying pressure there and a lot of investment decisions. Potentially this could even be where Warren Buffett starts to see value based on his indicator, which we'll discuss in just a minute. The next level would, of course, be the pre-GFC highs, and that will be where I would expect the market to literally bottom out. That would be an incredible fall. Is it possible? Anything's possible during these times, but that level there would be presenting incredible value, and Warren Buffett's indicator would surely be signaling value at this time. So when it comes to investing for the longer term or looking at technical analysis, always be aware of what's happening on the larger timeframes. This acted as amazing support in terms of the previous highs. This will act as amazing support around the 16,000, and if it did get low enough, 14,000 would act as amazing support. And the reason we say all of these levels and we're looking at the Dow is because when times are tough, large market cap companies are the ones that people love to get into. And that's because they get the stimulus from the government. They're the ones that can be effectively controlled by the government and effectively saved. During the GFC, the same thing happened. And we had a discussion about the Russell 2000 the other day where we mentioned that the Russell 2000 has many companies that could go bankrupt. Whereas the Dow, it's incredibly unlikely that any of these companies are going bankrupt. They might suffer, but they will, generally speaking, come out the back end. So this is more of the kind of investment that potentially Buffett would make. So as promised, here is the Buffett Indicator. And what is the Buffett Indicator? Well, it takes the combined market capitalizations of a country's publicly traded stocks and divides it by quarterly gross domestic product. Investors use this to, of course, then gauge whether the stock market is overvalued or undervalued relative to the size of the economy. It's actually a great indicator, and a lot of people are aware of it, but some people aren't. And it certainly is one that you should be putting on your watch list during times of uncertainty and even during times of bull market runs. So here is the first chart, and this is sourced from gurufocus.com, so you can check them out after the video if you'd like to. Total market cap and US GDP. Great chart. Look at how it's tracked over time. So we have the GDP with the green line, and then we have the, of course, Wilshire total market underneath it. Now, it tracks relatively well over time, but let's look at the key points. So the first key point is overvaluation of companies of the stock market off the tech crash. So this is the tech crash. And you can clearly see a massive overvaluation of companies to GDP. And there was, most of the companies, in fact, a lot of the companies that were in the S&P 500 or any of these indexes back then, they just didn't even survive. Some of them had no earnings during this time. So we all know the story of the tech crash. The second one, which is a little bit more interesting, was the GFC. The GFC was not necessarily an overvaluation of companies. It was hideous debts across the board that spurned into something else. And that's why the GFC in every crash is slightly different. Then we have the GDP of America versus the current market conditions. And if we took this chart, we'd pretty much be around here right now. So around this point is where we are right now. Well, what do we notice straight away? This market's really high compared to the GDP over the term. So the best thing to do would be to basically take the mean and the median, and we will do this in a second. But look how high it is compared to the GDP. And this, I would say, is because of the Fed. And many people don't like the Fed, but it's got to be said that QE has done this. QE has basically put so much money into the system. Profit earnings ratios are different to what they were before, and therefore valuations are expected to be higher than before. And we talk about this all the time on this channel. We will continue talking about this. So make sure you do like, comment, and subscribe, because we've got some great content that we're going to be bringing you daily during this crisis. But this is the total market cap in terms of the US GDP. Let's look at the next chart now and see what else we can learn about the Buffett Indicator. So here we've got the ratio of the total market cap to US GDP. And again, interesting things that we can learn. The ratios don't really lie in this case. During the 1980s and 1990s, there was pretty undervalued companies. This is when Warren Buffett actually made a lot of his money. And now we have an all-time peak followed by, of course, that recent crash. And we're probably sitting again around here right now. So we are sitting literally at the point where the tech bubble valuations didn't make any sense. GFC, a little bit different. So every one of these crises, again, will be different. But look at the tech, look at where we are right now, and check that out. Wow, we are still very, very high. So where do we believe it's going to go? Remember, this is sitting at over 125%. So we're probably sitting about 135% and the ratio of total market cap to the US GDP. Well, here it is, the all-important ratio to valuation. And this is what Buffett will be looking at when it comes time for him to invest in the overall US economy. Ratio of over 115%, considered significantly overvalued. Where are we now? Significantly overvalued. So amazing when you think about the overall valuation on all companies. What about when it hits 90 to 115? Modestly overvalued. And then, of course, 75 to 90 fair valued. So do you think that Buffett is going to be at certain points. I would say Buffett will use an averaging in kind of concept where he might look at all of these as being opportunities to put his cash at work. When you look at his report that came out, he has added further cash to his portfolio. So I'm sure Buffett is going to be sitting here and he is going to be looking at these key levels, specifically the modestly overvalued, fair valued, and modestly undervalued. And where do we think these points are going to happen? Most likely at key technical zones as well. So you look at the S&P 500, you look at the NASDAQ, you look at the Dow. If it's sitting at key technical support and you're getting an alert from this type of indicator saying, hey, buy, guess what? You bring those two together, you have an amazing chance to make great investment decisions. And in some ways, investing is as simple as that. Obviously, there's a lot more nuance to it. There's psychology and all these types of things we will cover on the channel, but this is just so interesting. And if you don't get excited by this kind of stuff, then I don't even know if you should be a trader, because these indicators, they do work over the long term. Buffett used this very successfully, and I can tell you that it makes me excited, and I've been in this game for well over 12 years. So make sure you like, comment, and subscribe if you enjoyed the video. We'll see you in another daily video tomorrow, and happy trading everybody on Market Open. See ya.